Thanks for tuning into Talking Point. I'm your host, Niraj Shah. My next guest today, or my guest today, has always told me that you don't have Nifty futures in your portfolio. So stop bothering about the market so much. Focus on businesses and what businesses could do over the medium to the long term. I guess he uses the index levels as tactical entry or exit points. The question, though, as we are at somewhere in between from the bottoms and from the tops that we've seen in the markets, is how to go about picking businesses and what are the businesses, the models of which look very well poised over the medium to the long term. Let's get in Nilesh Shah, MD and CEO of Envision Capital, who joins us right now on the talking point today. So good having you. Thanks much for taking the time out. Hope all is safe.
Yes, thank you, Niraj, so much. And yes, all good, all safe so far. And wish you and your viewers the same.
Yeah, thanks, Nilesh. The question is all safe from an investing perspective in the markets because everybody kind of uses this Nifty level as the barometer of whether the risks are weighed against you, stacked up against you, or the tailwinds are there in favor of yours. What's your thought?
Yeah, I think this is a pretty pertinent kind of a question. And I think it's the moot point given the kind of advances that we've seen from the lows of March. Uh, I think for investors, it's very, very important to kind of keep in mind that the challenges related to COVID and lockdown still persist. I don't think it's something which is kind of going away in a hurry. Hard to kind of put a time frame how long this could take. It could be a few weeks, few months, few quarters, or maybe even probably a year or two. But the good or the positive part of all of this is that we as individuals, we as citizens, and we as corporates have begun to kind of learn to live with it. How to essentially adjust ourselves, how to adapt, how to calibrate, and how to basically kind of make the most of this environment. And I think that's the key takeaway from all of this. And so the way I would look at it is that the risks are likely to persist in the short term. But I think as we step beyond 2020, I see more opportunities versus risks. I see many more other avenues to basically kind of see how the build-up can happen versus basically the challenges that we are seeing in the short term. So I'd probably say that yes, for the current year, maybe the risk reward is still kind of neutral. But I think beyond 2020, I see a recovery and I see the risk reward turning hugely favorable and positive for essentially medium to long term investors.
Are you buying businesses by ignoring 2020 completely and looking at FY 21, 22? I can understand a lot of people who, mutual funds, for example, who are invested fully, kind of also have to do that. But you have a choice of being on cash versus being fully invested. So what are you doing? Are you investing, keeping 2021 in mind and ignoring 2020 completely?
Yes, Neeraj, I think anybody who tries to figure out how FY21 or how CY 2020 is I'm not too sure he's being realistic. Because honestly, we really don't know how it's going to actually play out. We could all be, hopeful and optimistic, saying the recovery will start with the September quarter and December quarter and all of that. But it's going to be hard, and I'd probably say impossible to kind of do that, barring maybe say the banking sector, where to some extent there is a linearity in terms of their business, and of course we know that there is a moratorium on repayments, which will start kind of come to the fore only basically starting 2021, the calendar year 2021. But otherwise, I think uh, prudence would require that by and large we ignore FY21. If you pay too much attention to FY21, the risks you run are basically of going horribly wrong. So to that extent, I think we probably need to look beyond FY21 and see how the recovery will unfold and how individual businesses make themselves more robust so that investors really have a significant opportunity for the next 3 to 5 years.
Hmm. But Nilesh, there are businesses which in FY 20 itself, for the current quarters itself, are actually showing resilience, be it IT, and we've seen that in the last 3, 4 numbers that have come out. And the commentary or the performance or both has been okay. Some specialty chemical company commentaries as well. Pharma, for example. There are manufacturing businesses like there's a mid-sized company, GMM Fodler. I'm just using that as an example. example, with a bunch of these businesses which are actually saying that FY or FY21 for them as well will not be as bad as people envisage for the other businesses. Do you reckon that the multiples of some of these could actually inch up dramatically from maybe average multiples or current multiples?
Uh, yes, I clearly believe that global facing businesses continue to be in a sweet spot, barring some bit of disruption and dislocation which happened probably with them during the early stage of the national lockdown. But otherwise, I think if I were to kind of read with their stock exchange filings and the updates that they are required to give on COVID, barring the initial challenges which they faced, they all have come back to normal operations. And their businesses essentially are pretty much non-discretionary to the world as a large. I think there are strong competitive advantages which India has in sectors like pharmaceuticals, technology services, specialty chemicals. These are things where Indian companies have had customers, clients now for years, for decades. They've developed strong niches, they've developed strong capabilities and competencies. And to that extent, the supply chain, which was essentially broken in between, has kind of in a way restored and they're back to business. So probably yes, that even in the current financial year, some of these businesses would pretty much be in a way business as normal for them and it would be robust for them. And I still believe that in the world, I think, is going to find it difficult to kind of live without the services and the products which some of the companies in India are essentially providing in areas like pharmaceuticals, technology services, and specialty chemicals. So I think that's an opportunity and a space that we are very excited about.
Okay. Nilesh, I'll just take a moment here and dwell upon this before we move on to the larger macro too, since we've dwelt upon sectors, because I thought we'd come to that a bit late. But since we moved into it, just a quick follow up, because I know very few people other than you who track, who have such a grip on how technological businesses and Indian technology, for example, have done over the years and can do going ahead. What's your sense? For the longest time, Indian IT has been ridiculed as being, service provider, low-end service providers did not gear up to make products the way global IT companies did. My question is, there is still space for the service vendors to increase businesses in this highly digital world, right? What's your sense of how would Indian IT participate in this? And can they actually prosper meaningfully over the course of the next decade?
So there are two sets of opportunities here, Neeraj. One is essentially the conventional, traditional IT services, which is all about application maintenance development. So that is one area. The second area, of course, is the digital space. That how do you essentially make your customers digital ready? And I think some of the big IT services companies have been able to kind of have that transformation happen purely from 100% conventional to some piece of digital, which is becoming meaningful. Now, in both these pockets, essentially the growth is going to be in single digits on an aggregate basis. But the third big area is essentially specialized IT services, specialized technology kind of capabilities where you're helping your customers to kind of becoming more IoT ready. You are kind of in a way helping your customers to kind of provide the best of products for them. So I clearly believe that areas like product engineering services, offshore product development, where you really partner with some of the large R&D driven corporates worldwide to essentially kind of become more future ready. And I think that specialized space, I think, is probably the most attractive sweet spot from a medium to long term perspective. And that probably can be an important focus area. So, yes, I think the established bellwether IT services companies probably just keep providing you various valuation arbitrages and multiple arbitrages and probably will do well in an environment where the currency is not so strong, the rupee is not so strong. But I think there is life beyond the conventional IT services, the conventional rupee depreciation theme and all of that, to really look for companies which are essentially helping their customers to be more ready for the future in areas like product engineering and offshore product development. And that's really an interesting opportunity to basically focus on.
Okay, so from your answer, I'm guessing you're finding such companies. A follow up to that is somebody who told me, Nilesh, I think management told me, if I'm not wrong, Tech Mahindra or some other company, I don't know, but they said that maybe just maybe global businesses or global clients might actually look for the larger IT vendors simply because they would want multiple delivery centers, companies having multi-speciality possibilities, etc. So, in your investment thesis right now in IT, are you bucketing them into large cap versus mid cap as well, or the larger size versus the smaller size? And are you bending towards the larger size?
Uh, yes, Neeraj, that's a very kind of a interesting kind of a thought, and you always tend to do this, because I clearly believe that in services business, size does matter. For that
Okay.
matter, of course, in most businesses, size do matter. But apart from size, I think most of the vendors out there are looking at some kind of an overlay of your capabilities and competencies, and what is essentially the value add that you are doing to your customers in the developed world. So it's not just about your size, but it's also about your capabilities, it's your competencies, and your ability to cater to their requirements and help them to kind of deliver better value to their own set of customers and to their own markets. So I think apart from size, capabilities matters equally, and I think the ability of, not, I would probably say, a completely mid-sized company, but probably somewhere in between being a large sized and a mid-sized company, somewhere in between is the sweet spot where your ability to essentially learn, unlearn, learn, and adopt to basically the new technologies, I think becomes extremely important. And that's what I think your customers in the developed world are looking at, saying is that I want to essentially provide cutting edge and take the lead in my market, and who is the best partner in a country like India for you to essentially collaborate, take the services, and be ahead of your competition in the marketplace. That I think is very important.
Okay. One follow-up. I don't want to make this an IT discussion, but I thought since you are here, I'll ask you. Do you reckon, Nilesh, that there is a possibility, and what are the chances of that to happen, of course, for two things to move up? One, the margin profile of the Indian IT vendors, which has now been probably in this range. I mean, whatever, 18-20 for, say, for example, an HCL Tech, or 24-25 for Infi. Can that move up over the course of the next 5-10 years because of the nature of the services that they're providing? And two, can valuation multiples move up? Because for the longest time, right, I've heard this argument about why IT services can't trade at valuation multiples of consumers. Maybe they still can't, but can the multiples move up from where they are right now? So
Uh,
those two questions.
I think in both cases, I would be a little circumspect about
Okay.
margins expanding as well as multiples expanding. And that's purely because, Neeraj, I think if you look at the larger set of companies, their margins are already between 22 to 25% operating margins. Okay. Those are fantastic margins to kind of have. Okay. And unless you bring in non-linearity to your business, unless you create products where essentially you start basically getting pricing, you start having pricing power, and you move away from this essentially this bids oriented business into essentially a pull kind of a business where there is a pull for your products, it's unlikely that non-linearity will step into your business. And if you do not have non-linearity, it's very unlikely that you will be in a situation to expand essentially margins. But I clearly believe that that's really not where the opportunity lies. The opportunity lies essentially is in the size of the opportunity, the size of the market. And I clearly believe that Indian IT companies are targeting a pretty large ocean of spending on technology. And I think that's clearly where their edge comes in. So I think the priority for a large IT services company out of India should be essentially to kind of ensure that you kind of start getting a reasonable share or a meaningful share of that ocean of spending, which is really happening. And therefore, I would probably think that it's important to drive growth, drive revenue growth, and get up to kind of even a much more larger size over the next 5 to 10 years, rather than just expanding margins. Because if you're going to be focused on expanding margins in the conventional technology services arena, somebody else is going to come and eat your lunch. Okay, so you've got to be very careful about that. Disruption is the name of the game, and disruption can happen even in technology services. So I think that even the larger technology services companies will have to be very mindful of that and be more focused on bringing non-linearity to their business, and they can do that only by disrupting basically the existing kind of set of services. So my sense is that unless you don't disrupt, unless you do not bring non-linearity to your business, margins are unlikely to expand, and if margins don't expand, multiples will not expand on a sustainable basis. So I still think be focused on revenue growth, be focused on having a larger share of an increasing pie. I think that is essentially what the focus should be. In the meantime, if you can create capabilities around products and over the long term, basically get in linearity, I think that would be essentially a great situation for them to be in.
Superb insight, Nilesh. Thanks for that. Okay. Now move on from services to the products, right? Just one last piece on this global facing businesses. So we have these service providers and then we have the product manufacturers like pharma, specialty chemicals, etc. And they seem to be well placed, but the multiples also are no longer as cheap as they were 6 months ago, right? For any of these businesses. So what gives here? I mean, one of your peers was telling me that train छूट गई है VT से, लेकिन अभी तक मतलब थाना नहीं पहुंची है. अभी भी it's still at Dadar, so we still have some time to go. What's your sense?
Well, the idea should be to essentially kind of, it's like this, Neeraj, that the runway of growth is pretty long and large for them. Okay, uh, I think Indian pharma is going to experience a stretched runway and a takeoff and a very, very long journey. And I think because clearly the kind of capabilities which are there with Indian pharma, I think are unparalleled and unmatched. Their ability to essentially launch cost-effective generic solutions clearly for the developed markets, I think is a key takeaway. The fact that they are basically contributing to making healthcare more affordable globally, I think is very, very important. I think they're focused, I think, on a very clear-cut value proposition for the global society. And that's what, so I think it's a perfect blend of providing value to the global society and essentially matching up to the chemistry skills and the discovery skills which Indian pharma companies have essentially over a period of time nurtured. So clearly, I think it's in a way a matching of like-minded propositions, so to say. So to that extent, I think Indian pharma is sitting on a multi-billion-dollar opportunity over a period of time. They have further honed their chemistry skills. They've developed the ability to basically comply with the stringent regulatory requirements of some of the very well-regulated markets like the United States. And they have also been able to therefore provide quality products to some of the other semi-regulated or developing markets. So I think the opportunity is huge. And so to that extent, I think Indian pharma has a significantly long run to go. Yes, the valuations are no longer as cheap as where they were maybe a few months back or maybe a year back, but I still think that the growth will keep surprising you on the positive side. And so to that extent, I probably think that one has to be constructive about this space and try and kind of have a multi-year horizon.
Okay, so try and have a multi-year horizon as far as the global, some of the product pharma companies at least, and I'm guessing that would probably hold true for maybe specialty chemicals as well. Nilesh, moving on, in your opening answer, you gave us a small thought about what would happen to financial services, right? Because you said that except for financial services or banks, essentially, most of the others have a lost year. What about banks? I mean, we're seeing evidence of the stronger ones really performing with HDFC Bank's numbers, isn't it? I mean, it seemed pretty cool in terms of what they delivered, even though there were some chinks in the armor. What's your thought?
Yeah, so India's banking sector, in a way, the kind of movements that we've been seeing in the developments, I think it's pretty paradoxical. The way I see it, if we look at the domestic economy, there are sectors like autos and all of that where there is not going to be recovery in the current financial year, but the stock prices have moved up quite significantly. Versus that, banks actually will have a good year because of moratorium. Okay, but the stock prices have not had as significant a catch up versus some of the other players which are proxies to the domestic economy. So to that extent, I still believe, and I think somewhere that investors and probably the markets are misreading that, and that's why I call it basically a very classical paradox. And therefore, I probably think that in the short to medium term, Indian banks will actually do very well, despite the kind of alarm bells which are coming in from different pockets. And yes, some of those concerns will play out, but I still believe that the risk management has become relatively robust for most banks. So I think be focused on the top rung, well managed banks who have a robust risk management in place, whose managements are very alive to the possibility of slippages. I think that's very, very important. And I think those banks which will focus this year on asset quality and the balance sheet, and of course being adequately capitalized, will emerge to be winners as the economy starts bouncing back from calendar year 2021 and onwards. So that I think one has to be very, very mindful of. And therefore, I would be positive on well-managed and leading banks who are well capitalized, essentially at least for this year. So I think probably banking actually paradoxically could end up being, uh, in a way, a contrarian bet versus essentially what the consensus is out there.
And Nilesh, would you believe that the big is bigger or big will get bigger and better argument would hold true, and the valuations still support that? Because a lot of people might still be caught in the lower priced ones, and people find it difficult to swap because people just find it difficult to accept that I did not buy an HDFC Bank at 1,000. Now how do I buy it at 1150? Or I didn't buy a Kotak at X. Why do I buy it here? Is it still uh, uh, a pocket of opportunity? This whole larger quality bank space.
Oh, absolutely. I mean, yes, one could basically look at it saying what were the March lows and saying it's moved up from there. But look at it, where were they pre-COVID levels? And they're still kind of at a meaningful discount to where they were on a pre-COVID basis. And the results of HDFC Bank over the weekend, I think in a way validate that basically even in tough times, basically they have been able to deliver. So I probably think that you essentially need to focus on these kind of banks who will still basically grow and compound their intrinsic value even in tough times. And the price decline versus the pre-COVID levels only creates an opportunity for medium to long-term investors. Number one. Number two is, I think, Neeraj, yes, size is important for every business, and so it is important for even the banks. But I still think that there could be opportunities in the next level of banks as well, where banks are more conscious about basically the risk that they are taking. Keep in mind that the business of credit and the business of lending is more about risk. How do you understand risk? How do you assess risk? How do you price risk? That's extremely important, because you have to keep in mind that you are making just a 2 to 4% net interest margin by putting to work basically 100 rupees of overall capital, of which only 10 rupees is your net worth. The balance 90 or 100 rupees is leverage. So it's very, very important that you are able to basically understand, assess, and price risk very well. And that is really where the key challenge for an investor lies, that how does he assess the price, the risk management system of the bank. So it doesn't matter whether it's too larger bank or too smaller bank. What is very important is the ability of the bank, the DNA of the bank, to understand and price risk.
And what about the non-risk, non-credit, non-lending financial businesses, Nilesh? The last time that we spoke around Diwali, not last time really, but when we spoke about Diwali, when you had come to our studios, if you remember, you had mentioned that you like this spate of businesses, insurance, AMCs. Maybe I could even throw in brokerages. That you didn't say that, but I'm still asking because of the number of demat accounts that have opened up of late. What's your sense now on these businesses?
So, well, I'm extremely excited about the long-term potential of these businesses. I think this is a huge structural opportunity. This is pretty much like how the consumer businesses had evolved from the 90s, how the private credit business, the lending business had evolved after that. And I clearly believe that, we have very low single-digit penetration levels, whether it be for a mutual fund product or a life insurance policy, for a general insurance, health insurance. I clearly believe that this is a very, very exciting space, and I think it's hard to ignore this opportunity. So far, this business has been significantly led by distribution and your core franchise, but I think the next big opportunity is for these players to very successfully adopt technology, go digital, be online, and reach out to the millions of consumers and millions of households which are there, not just in the urban top 10 cities of India, but in the hinterland, in the rural areas, the semi-urban areas, and I think really kind of get them into the mainstream of financial products. And I clearly believe that digitalization, I think, is going to be a huge opportunity for essentially the non-credit players, be it in insurance or mutual funds, or maybe even in terms of brokerage. Um, I think it's again an extremely good opportunity. So I think clearly that financials in India are not just about banks. They have been about banks, but I think it's now time for basically a move over from just banks alone to also banks and some of the other businesses like insurance, general health insurance, general insurance, life insurance, mutual funds, brokerages. I think a whole bunch of those kind of opportunities are there, which are there for maybe not just the next 1 or 2 years, but maybe for the next 5, 10, 15, 20 years as well.
few options, Nilesh, here, and therefore the market has lapped up whatever seemed good. You believe that the runway for growth provides you comfort in valuations, or do you don't think that it is that expensive any which ways?
Why? I mean, yes, valuations are no longer as reasonable as where they were a year back or a year and a half back when we had first identified them, and that's around the same time when a lot of these businesses went public.
Yeah.
But Neeraj, despite the adversity, I clearly believe. Again, I think last week, towards the weekend, ICICI Lombard came in with their performance, and that's essentially our portfolio company. It's an investee company, and they came in again with very reasonable and very good performance despite the challenges and despite the fact that car sales didn't happen, and therefore they lost out on motor insurance. But then they had lower claims, and I think they, despite all of this, they've had a 25% return on equity, a 25% ROE, which I think is exemplary in this environment. Uh, but Neeraj, I think look at it the other way as well. That over the last year and a half, there's been a fresh supply of the stock because a lot of their long-time shareholders, be it essentially the strategic partners or some of the private equity funds which own them, they've had to do exits for whatever reasons because they had to essentially move out of some of these positions after a well-defined in holding period. Despite that, these companies or these stocks have done relatively well. They have held up, they have marched on, and I would probably attribute that to their sustained performance so far and the very long-term opportunity aided by the under-penetration as well as embracing technology and digitalization for them to basically continue to grow on a very, very sustainable basis. So I would essentially not be too worried about the valuation at which they're trading at, given the kind of multi-year opportunity that these kind of businesses offer to long-term investors.
Mm. Because remember, some people view these exits as a question mark as to why is it that these large shareholders are exiting if there is such a great growth opportunity. But yeah, Nilesh is putting it in the other way around. Despite these exits, there has been enough buying appetite by other large investors for these businesses or these stocks to do well, and the businesses is anyways doing well. Now, Nilesh, a bit of a question that has kind of come up to me in the last 20 minutes of our conversation. All through the years that we've spoken, you've uh, you've kind of identified niche bottom up opportunities and not necessarily trending plays. What is it that has stood out in these last 3 months in terms of niche bottom up areas? Because all that we've discussed thus far is something that a lot of the street also believes in, right? I mean, banks, Huaya, for that matter, the global facing businesses. Is there something which is really struck to you as in amazement? Maybe digital opportunities that some businesses did very well, or some other things. Anything that has struck to you as
Yes,
as interesting?
yes. So I think Neeraj, what's really going to happen, I think, is I think a fantastic confluence of the sharp uptake that we are seeing in the rural economy,
Hmm.
the capabilities on manufacturing to deliver to kind of manufacture competitive products, and at the same time essentially digitalization and the kind of way geo has unfolded from strength to strength, which I think clearly expands the market multifold from an access point of view. So the way I really look at it is that the buoyancy in the rural economy is driving essentially, which is getting driven by farm incomes, is going to leave more disposable income in the hands of several households in essentially the semi-urban and the rural areas. And I think that is going to help them to basically spend on some of the home appliances, kitchen appliances, and maybe even improving their overall homes, and which essentially going to drive demand for that. And I think that with the kind of platform that Geo has been able to kind of or is building right now, it will help a lot of small emerging businesses to reach out to those millions of consumers in the length and breadth of the country. And I think that's really where the big opportunity lies. And I think along with that, the competitiveness of manufacturing, Indian manufacturing, is going to increase significantly because of lower taxes, lower interest rates, and maybe some of the pending structural reforms around land and labor. On the whole, I think is also going to make competitive manufacturing a lot more competitive. So I probably see for the first time that a kind of a confluence happening, that different things happening in disjointed manners are essentially kind of making a lot of businesses more competitive and will provide them strong tailwinds to grow. So I clearly am very positive about essentially the rural economy doing well, because they are going to be provided competitive products aided by strong technology coming in. And I think that's clearly where a very unique set of opportunities that we're seeing as long-term investors as far as India goes.
Interesting. Nilesh, a couple of final questions. I mean, in which case, let me ask you, do you reckon that we could actually see the return of the manufacturing boom of sorts? Because hitherto, China and some of the others have clearly outstripped India when it comes to manufacturing capabilities, except for a few sectors. But now I was reading over the weekend how both labor costs, power costs, etc., India is faring a lot better. I mean, if a few things can fall right, can we actually see a return of manufacturing for the world of sorts in India come up?
Oh, absolutely, Neeraj. I'm extremely excited about essentially Indian manufacturing going forward. Clearly, if I were to kind of really look at the backdrop, the last few years, the whole focus has been essentially to kind of see how ease of doing business really happens in India, whether it be the GST, the bankruptcy code, and of course falling interest rates, tax rates at record lows, and then of course the kind of labor reforms which have just been initiated. I think this essentially provides strong tailwinds. In addition to that, of course, geopolitical winds are essentially clearly blowing in favor of India, as companies world over look at India as an alternative manufacturing destination. And of course, with the pickup of the domestic economy, clearly that provides critical mass to a lot of the manufacturing oriented businesses. And therefore, I would be very, very positive on some of the manufacturing businesses. We own some of them, but we're very excited to probably still kind of dig deeper and go out there and figure out which kind of companies would be big beneficiaries of that. I know for a fact that one of the sectors which will stand to benefit quite disproportionately would be the entire auto ancillary space, because India's automobile market itself is very large. And I clearly believe that as the automobile sector comes back in 2021 and beyond, you will basically see auto ancillary companies in a way become more competitive, gain from some of these reforms which have happened, and gain from some of the other potential reforms, and become more competitive, and cater not just to basically the OEMs in India, cater to the replacement market in India, and basically cater to a global market driven by cost competitiveness and their ability to provide products at the appropriate kind of technology mix. So I would be very excited about that one space, in addition to, of course, pharmaceuticals and some of the other sectors that we kind of discussed early on. But yes, I think in terms of industrial consumables, material sciences, auto ancillaries, these are some of the big opportunities where India actually can have its meaningful share in a global market.
Well, if anything, it seems to be an exciting time ahead from an investing perspective. And Nilesh, we hope to hear more of you during this journey as more and more people can benefit out of it. But thanks so much for talking to us today on Talking Point.
Thank you, Niraj. Stay safe, and best wishes to you and your family and all your viewers.
Likewise to you, Nilesh. Really appreciate your time.
Thank you so much.
And viewers, thanks for tuning in to this edition of the Talking Point.